Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. It is always necessary to go further into details to understand what is happening in the market. Merely looking at Nifty 50 and Sensex will not give you an understanding about what stocks, how the stocks are actually moving. Now, for example, if you take the case today, the Nifty 50 was flat. Sensex as well as Nifty 50 ended on a flat note. Nifty 50 ended minus 12.40 points. Correct, but if you go deeper, if you check other indices, the bank Nifty rose by 482 points. Nifty mid cap 150 index rose by 269 points, whereas Nifty small cap 250 index rose by 320 points. So even though the top 50 companies were quite stable in their performance today, the real play was happening in the bank as well as mid cap and small cap indices, where the stocks were in a positive. Correct. So it is always necessary not to just scratch the surface, but to look deeper and understand what exactly is moving and turning in the market. Yesterday, in an interview to NDTV Profit, Rhythm Desai, who is the managing director of Morgan Stanley India, quite bullish on India, said that it is a stock pickers market. In the sense, you have to look at individual stocks, check their intrinsic value, their if they are the fundamentals and financials are strong, what does the future look like for that particular company, and then take a decision rather than focusing on macro. He says it is time to look at micro level and then search for good companies. Correct. S Naren, a few days back I had spoken about him, had said that it is time to look at large cap. Why? Because they give you that stability. But not all large cap stocks are reasonably priced even now. Correct, they are also overpriced. So which are the companies where it is a good time, where you can put in your money and reap the benefits of investing in this bear market? We searched and studied the stocks, and today we are going to talk about one such company which has given a good performance in its Q3 results and is currently facing selling pressure. Might be a good enough time to take a call about whether you want to invest in this company or not. Today we are going to talk about Varun Beverages Limited. Before we get into the details and fundamentals of Varun Beverages, a little background about the company. Now, Varun Beverages is a key player in the beverage industry. It is the largest franchisees, the largest bottlers for PepsiCo outside the USA. It was formed in 1995 as part of RJ Corporation. Now, RJ Corporation was founded by Ravi Jaipuria, who is often called as the Cola King of India. Besides Varun Beverages, he also owns a company called Devayani International, which has the largest franchisees of Yum restaurants. Now, they also operate other franchisee chains in the country like KFC, Pizza Hut, Costa Cafe, to name a few. So, what the company does is it basically produces and distributes a wide range of aerated and non aerated drinks under the PepsiCo trademark. It is also one of the manufacturers and distributors for Aquafina, which is the bottled water brand of PepsiCo. Now, though Varun Beverages is not a monopoly, it has a competitive advantage over other such players in the industry. Why is that the case? Why? Because of its extensive distribution network and strategic manufacturing locations. Add to it a good relationship with one of the key players in the beverage industry in the world, PepsiCo, right? It has more than 100 manufacturing plants across India and international market, which allows wide market coverage and reduction in transportation cost to the company. Now, as of 2024, Varun Beverages operates in 27 states and 6 union territories in India. Outside of India, it has operations in Nepal, Sri Lanka, Morocco, South Africa, Congo, many other African countries. It has distribution rights in Botswana, Madagascar, Mozambique, and Namibia. While PepsiCo products form the core of Varun Beverages business, it has recently expanded its operations and has started manufacturing snacks in countries, like Morocco, Zambia, and Zimbabwe. Now, Africa is one such market which is still untapped, and many Indian companies like Varun Beverages, Airtel is one other example, which are vying for this market to expand their businesses outside India. Many of us are aware of the various beverages that PepsiCo has in India, like Pepsi, Pepsi Max, 7 Up, Mirinda, Mountain Dew, some non aerated drinks like Slice, Tropicana, Nimbus, Gatorade, and bottled drinking water like Aquafina. Many of us are aware of all these brands which are easily available at any shops around the corner. Correct, but most of us might not know that Varun Beverages is the manufacturer and distributor of these brands under the trademark of Pepsi in India. Now that we know what the company does, what its business is, let us go into further details and concentrate on the fundamentals and the latest quarter results which were announced by the company around a week back. Now, the profit after tax for the company for the quarter ended December 2024 uh, stands at 196 crore rupees, which is a 38% rise year on year basis. The revenue from operations has also risen by nearly 40% to stand at 3688 crores. Now the headlines tells you these details, but it is necessary to dig deeper, to go further. Now if you compare the December quarter results with the previous quarters, say September 2024, June 2024, March 2024, the net profit has suddenly decreased compared to all these three previous quarters, where the profit in March 2024 stood at 548 crore rupees. It rose to 1262 crores in June quarter and came down to 629 crores in September quarter. Now, this should raise an alarm. Why is the profit almost reduced by half in September quarter and more than half for the quarter ended December 2024? What is the reason? Has the business reduced? Well, that is not the case. Let us look at the details as to why profitability has gone down. In its management commentary following the results, the management said, gave some of the reasons for the reduction in profit. Well, the first reason that the management gave was rising raw material cost, where it cited that the cost of sugar, flavoring, glass bottles, and packaging materials rose by 41% year on year basis, which outpaced the growth of revenue, which stood at nearly 40%, right? There was also a high VAT in some of the regions, which contributed to increased expenses. Now, this is not the only reason. There was increase in depreciation and finance cost. Depreciation expenses increased by 57% year on year basis, basically due to addition of new production facilities, and it recently acquired new plants in international markets in South Africa and Democratic Republic of Congo. Now, this has added to the depreciation cost of these acquisitions of the assets that the company has acquired. The finance cost also rose by nearly 48% year on year basis due to debt incurred for acquisitions and setting up new facilities. So, these were some of the main reasons why the profit margin has reduced in comparison to the previous quarters of the same financial year. Now, even though the December quarter profitability was reduced, if you compare yearly profitability, like for the year ended December 2024 with the year ended December 2023 and previous years, the profit has in fact increased. The profit for December, like the year ended on December 2024, stood at 2634 crore rupees compared to December 2023, where the profit stood at 2102 crore. So in fact there was a 25% rise in PAT when you compared it on year to year basis. Now, the explanation that management has given in its commentary for this reduction in profit for the December quarter, well, I'll read it out. The company has been aggressively expanding its operations in territories outside India, particularly in Africa, and setting up greenfield projects in India. Now, while these investments are expected to drive long term growth, they have temporarily increased cost for the December quarter. Now, the management remains optimistic about the future, and rightly so. Their domestic volumes grew by 11.4%, showcasing a strong demand for their products in India. Consolidated volumes increased by 23.2%, driven by international expansion. Now, the company says that the margins are expected to improve after the new facilities stabilize and operational efficiencies set in. Let us look at the fundamental factors. The PE ratio stands at 62.1, which is a shade higher than the industry average. If you look at the PB ratio, price to book value, it stands at 9.69. Now, what does this mean? What is price to book value ratio? Basically, price that people are willing to pay in comparison to the net asset. Book value means asset minus liabilities. So, what price people are willing to pay for the net assets of the company? So obviously people are willing to pay more looking at the growth prospects and past performance, hoping for a similar performance in the future. People are willing to pay a premium for this stock. If you look at the debt to equity ratio, well, the company is nearly debt free. The debt to equity ratio stands at 0.17%. So overall, the company is debt free, a tad overvalued, but again with good growth prospects. Some of the risk and challenges that you should be aware of while studying Varun Beverages. Firstly, its over reliance on one company, namely PepsiCo. Now, though their relationship has been good for many years, over dependence on just one company is always a risk. Secondly, the nature of their business is seasonal. Why? Because beverage demand increases during summers and tends to subside during winters. So there is seasonality in business. Raw material price fluctuation also possesses a risk, right? Like it happened in the quarter ended December 2024, where raw material prices rose by nearly 41%, putting a heavy pressure on their profitability. Such fluctuations in raw material prices can possess risk and have an impact on the profitability of the company. And regulatory risk, why? Because see, carbonated drinks are like many health experts always are of the opinion and keep on telling us that limit your intake of carbonated drinks because of their high sugar content and the health hazards that they possess on consumption. So there are chances that government might increase GST rates on such drinks, again impacting their sales. Let us look at some of the pros and cons of Varun Beverages. First, we'll check the pros. Now, Varun Beverages, as I have already told you, is one of the largest franchisees of PepsiCo outside the USA. So, the brand recognition of PepsiCo helps Varun Beverage enjoy a strong market position. Secondly, it is adhering to backward integration to reduce cost and improve margins. What it is doing is it is getting into manufacturing of PET bottles, the caps that are needed on those bottles, recycling of those bottles. It has expanded its operations backward to these businesses. What it will do is it will help improve their margins by reducing their cost and over dependence on suppliers of such raw material that they need. Some other pros is you cannot neglect that the company is almost debt free and has been reducing its debt. It has delivered a good profit when you compare it year on year basis. It has delivered a good growth of nearly 40% in its PAT. The If you check the return on equity, it has a consistent track record of nearly 27.9% return for the last 3 years. And the sales volume has also grown by nearly 25% in the last 10 years. So all these cannot be overlooked, which add to the investability of the company. Now if you look at the flip side, the cons, well, the company is valued, is slightly overvalued when you check the PE and the PB ratios. And one thing that you cannot ignore is the reduction in promoter holdings in the last quarter, which is December 2024, where the promoter holdings reduced by 2.46%. So that also is one of the factors that you need to take into consideration. Now, many analysts have also maintained their buy and overweight rating on the stock. Morgan Stanley is overweight on the stock with a target price of 675. MK has also held on to its buy rating. Motilal Oswal also suggests a buy rating with a target price of 680. So, many analysts are positive when you check this stock. To conclude, the beverage industry in India is rapidly growing. It is set to reach $21.5 billion dollars by 2028, basically because of rising per capita income and change in consumer preferences. And Varun Beverages is a leader in this space. So it possesses a unique investment opportunity. Given its strong relationship with PepsiCo, its near debt free status, its expansion into untapped markets like Africa, its focus on bringing more healthier beverages in the market, where the non-aerated segment of its business grew to 53% compared to 47% last year. Now, all these factors position Varun Beverages for a good future growth. But as always, it is necessary that you do your own research, consult an investment advisor to align your investment decisions with your financial goals. Let me know in the comments section what you thought of my video, if you liked the analysis, and which other company would you like to hear about. Please like, share, and comment and subscribe to my channel for more such informative content. Until next time, happy investing.